Hey, what's up, my friend? So, in today's episode, I want to share with you the top 3 beginners' mistake to avoid when trading candlestick patterns. So, here's the thing, right? I'm sure you can agree that candlestick patterns is one of the most popular way, right, to plot the prices on your chart. But just because it's popular doesn't mean that most traders are doing it the right way. So, let me share with you the top 3 mistakes that I see traders make. Number 1, when traders, they look at the chart and they see a huge bullish momentum, right? They will think to themselves, right? Oh, Rayner, look how bullish the market is, right? The market is going to the moon, right? Let's buy. And when they buy, what's the problem with this? Well, when you buy after the price has made such a huge price movement higher, you will face a problem. And that problem is, where do I put my stop loss? There is no price structure, there is no support, there is no swing low that you can reference against to set your stop loss. So what do? Well, you arbitrarily set a random stop loss on your chart. Maybe 20 pips, 50 pips, whatever you feel like it. Now, here's the thing, right? The market doesn't care where your stop loss is, right? After it made such a huge advancement in price, it needs to take a breather. It needs to pause. It needs to retrace. It needs to pull back or even reverse. And when that happens, guess what happened to your stop loss? Ka-ching! Gone. Just like ka-ching, gone. Just gone, right? Someone's going to take profit, right, where your stop loss is, and you get stopped out of your trade. Okay, so that's the first mistake to avoid. When you see the price, when you see the market make a huge move, right, that's a strong signal to you that you shouldn't be entering the trade. It's too late. Because that's where the energy has already expanded. Okay, it's too late to enter. Don't chase the market. Right, so avoid that. Number 2, the second mistake I see traders make is that they trade this, candlestick patterns in isolation. For example, they look at a chart. Oh, a bullish hammer, time to buy. It's a hammer. After all, the textbook, the courses say that if you see a hammer, it means the buyers are in control. I should buy, and you go long. Well, what's the problem with this? Again, a hammer simply tells you that at that point in time, momentarily, the buyers are in control. Yes. But it doesn't mean that the market has a high probability of going up. Why? Because you still must look at the current market condition, the context of the market, what's going on. For example, if for the last 200 candles, the market is in a downtrend, right? The price has steadily been making lower highs and lower lows. What are the odds, right, of that one hammer winning, right, against the last 200 candles, winning against the downtrend that's in place right now? Well, the odds are pretty slim, right? If you think about this, it's like having a Toyota Vios moving here and then having a train. Let's make this like this: a train moving at 300 kilometers per hour, and the Vios is going at 50 kilometers per hour. What's going to happen? The train will freaking eat the car up, man. The car will crash and burn. And that's what happened, right? If you buy a hammer, a tiny weeny hammer in an existing downtrend, you should expect to, get stopped out of your trade consistently. Right? And that's my point, right? You don't want to be trading candlestick patterns in isolation. They are not signals. They are not setups. They just simply tell you, right, historically what has happened over the last one candle, and that's it. I'll share more with you later on how you should trade candlestick patterns, but first, don't trade them in isolation. And the third mistake is this, right, is that traders, right, me included, right, I am guilty of this, is that you memorize all these different candlestick patterns out there. Right, let's be honest, there are so many variations of it, possibly hundreds of them. Hammer, shooting star, harami, abandoned baby, and engulfing pattern and whatsoever. And if you were to memorize all these patterns, the name of it, the meaning of it, you'll crash and burn. Unless you have, photogenic memory. I don't have, right? So I was very frustrated for a long time. So here's the thing, right? Don't memorize candlestick patterns. Instead, ask yourself, what is the market trying to tell you? And all you need to do is ask yourself these 2 questions. Just 2 questions, and you can understand any candlestick patterns that you come across. Let me share with you what these 2 questions are. First question is this: where did the price close relative to the range? A candlestick pattern has a high and a low. So ask yourself, where did the price close relative to the range? Did it close near the highs? Well, that means that, the buyers are temporarily in control. Did it close near the middle of the range? Well, maybe it's undecided, right? Buyers and sellers, they are, pretty much on equal footing. Or did the price close near the lows where the sellers are in control? So that's the first question. The second question you want to ask yourself is, what's the size of the candlestick pattern relative to the earlier ones? And the reason you're asking yourself this question is because you want to see if there's any conviction behind the move. Again, for example, let's say you spot a hammer on the chart. Okay? But let's say this hammer, right, the size of this hammer is about the same size as the last 5 candles, or the range of this hammer, the size is pretty similar or even slightly smaller, then what it's telling you that is that there isn't likely any conviction behind the hammer. But on the other hand, let's say you have another hammer that's being formed, and this time around the hammer, the size of this hammer is 2 times, 3 times larger, right, than the preceding candles. This tells you that this is clearly a strong price rejection. There is conviction behind this move, right? And that's how you read candlestick patterns, right? You want to analyze, right, what's the size of this pattern relative to the earlier candles as well. Okay, so these are the top 3 mistakes to avoid when you're trading candlestick patterns. So moving on, you might be thinking, okay, Rayner, so how do I trade candlestick patterns? So I'm going to give you a very simple formula to trade candlestick patterns. And if you want more details, right, you can just Google my YouTube videos later on. Just search for, I'll tell you later, right? But for now, let me share with you this thing called the M.A.E.E. formula, right? M.A.E.E. is spelled as M.A.E.E. Some of you might be familiar with it. Some of you is the first time. So let me explain. So what does M.A.E.E. formula stands for? M.A.E.E. stands for number 1, market structure. Number 2, area of value. Number 3, the entry trigger. And number 4, exits. So let's talk about market structure. If the market is in an uptrend, what do you want to be doing? Selling? No, of course not, right? You want to be buying, right? Market is in an uptrend. The path of least resistance is towards the upside. So you want to look for buying opportunities. But by now, you should know that just because the market is in an uptrend doesn't mean you want to blindly buy, right? You want to buy at a good price level, at an area of value. So that brings us to the second point, the area of value. So where is an area of value? There are many ways to define it. You can use moving average, you can use support, you can use trend line, trend channels, right? But generally, I like to use support, right? Trend lines or even moving average. So you wait for the price to come to an area of support, right? This is an area of value. So once the price has come to an area of support, then what next? Well, we have no idea whether support will hold or break. So that's bringing us to the third point, the entry trigger. We're looking for a candlestick pattern, a bullish candlestick pattern, right? To show us the buyers are stepping in to push the price higher. This could be in the form of a hammer, could be in the form of bullish engulfing pattern, etc. So that's the third thing. The fourth thing, right, exits, right? Just because you enter a trade, you have to have a plan of getting out of your trade. So where do you put your stop loss? Well, you can put your stop loss, let's say, 1 ATR below the lows of hammer. That's one. That's possible. Then how do you exit if the price moves in your favor? What if this is going to be a winning trade? How do you exit your winners? Well, you can look to take profit at the nearest swing high, at resistance. And that's, in essence, right, what the M.A.E.E. formula is all about. I know it might be hard to visualize right now. So just go to my YouTube channel, right? Just Google M.A.E.E. formula trading with Rayner, and you will see a video that pop up, and I explain all this in much more greater details, and really it will break down this concept, right, into a step-by-step manner. So with that said, right, I have come to the end of this video. A quick recap. Number 1, don't buy after a market that has made a huge move, because that's where it's likely to make a pullback or reversal. Number 2, don't trade candlestick patterns in isolation. Doesn't work that way. Number 3, okay, don't memorize candlestick patterns, right? Just ask yourself the 2 questions I shared with you earlier. Where did the price close relative to the range? And what's the size of the candlestick pattern relative to the earlier candles? Okay, and finally, we spoke about the M.A.E.E. formula briefly. For more details, just search on YouTube and you will get a complete training on it. So with that said, I wish you good luck and good trading, and I will talk to you soon.